Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Generally speaking, small cap stocks haven't had a brilliant couple of years. To be fair, it's quite a broad category. A small cap is generally considered a listed company with a market capitalisation of a few $1 billion or less. That certainly covers lots of companies, from retailers and miners to travel and tech companies. So after an ordinary year or two, is 2024 finally going to be the year for small caps? Remember, this is general information only, and you should always seek professional advice before making investment decisions. Tobias Yao is portfolio manager across 4 of Wilson Asset Management's listed investment companies: WAM Capital, WAM Microcap, WAM Research, and WAM Active. Tobias, welcome back to Fear and Greed.
G'day, how's it going?
Great. Tell me, is 2024 finally the year for small caps?
Look, we do believe 2024 will be a good year for small cap companies, given the change in the interest rate narrative towards the end of last year, and the fact that I think small cap companies in general have underperformed the broader market by more than 20% over the last 2 years. In fact, many small cap companies are trading at significant discounts to their long run averages, which is why we continue to see M&A activities in the space. Last year we've had the likes of Estia Health, Silk Laces, and Healthier. However, I would caution that the recovery is not going to be a straight line, given the plethora of risks that's still in the system, inflation, economic risks, geopolitical risks. And this year, it's going to be a huge year in terms of elections around the world, particularly in the US. And, there's going to be rhetoric that's going to come out of both parties leading up to the election that could impact equity markets.
Okay, so just a couple of things I just want to unpack on what you said there. It's starting from a lower base, basically. So 2024 small caps are starting from a lower base. So there's a discount to their average valuation in many cases. But as you say, it's apples and oranges. There's plenty of different stocks in there. So there's that to think about. What about the interest rate profile? So we've had 12 months ago, we knew interest rates were going to keep rising. As we stand here today, market consensus is there won't be any more rate rises. Certainly in the US, there'll be cuts, and possibly in Australia later this year, there'll be cuts. What does that mean for the sector?
Yeah, so the key for us is directionally, it's positive for small caps or risk assets. We're going to have a lot of macro data, on inflation or commentary from the various central banks around the world, over the next 12 months, and that's going to create volatility in the equity markets in terms of beating or missing expectations, and like it did when the rates was going up on the back of the high inflation rates. So it's not going to be smooth sailing, but in terms of our view, directionally it is positive that we're going into a rate easing environment. And in terms of how we approach the macro backdrop, we are bottom up stock pickers. So the key for us is to stick to our investment process, which is to just find undervalued growth companies with catalysts and to stick to what we're good at.
Okay, I'm going to ask you about those in a moment, but you were mid last year, you were on the show and you gave us a couple of tips. How'd they go? How was 2023 in some of your stocks? And this is a bit of a Dorothy Dixie here, because I do know you did pretty well.
Thank you. Look, fortunately, a couple of the companies which I mentioned on the podcast last time actually were probably our best performers. The best performer in 2023 has been a company called Tuas Limited. ASX ticker is TUA, which is the fastest growing Singaporean telco. Now, the board and the management team has done an exceptional job growing their business in Singapore. And the share price, rose from around, I think, about $1.20 at the beginning of the year and finished at around $3.
Wow.
And the company's founder and largest shareholder is David Teoh, who we believe has had the most amazing track record in the telco industry globally. And he also founded TPG Telecom here in Australia. And he's supported by the CEO, Richard, who's another industry veteran in Singapore. And they've grown their market share in mobile from 0% to now over 10% over the last 4 years. So as investors, we're really backing this team to continue this growth trajectory. And, it continues to be one of our largest positions. As we believe over the next 3 to 5 years, TUA or Tuas Limited, would be able to continue its trajectory of growth. Another stock I think I mentioned last time was a company called MMA Offshore. The ASX ticker is MRM, which provides marine and subsea services to the offshore energy and I guess the wider maritime industries. Another company with an amazing management team who came in initially fixed the balance sheet, optimized the business, and then given the favorable demand backdrop that we're seeing now, is growing their business significantly. The share price, I think, is up around 60% over the last 12 months. While we have reduced our position size along the way, MRM continues to be a pretty important position in the portfolio.
Stay with me, Tobias. We'll be back in a minute. I'm speaking to Tobias Yao from Wilson Asset Management. When we talk about large caps, many mum and dad investors particularly invest in Commonwealth Bank or Telstra or something like that for dividends. When we think about small caps, the companies you've just mentioned there, I don't know what their dividend policy is, but I'm presuming they're growth stocks. You're looking for growth in share price more so than dividends. How do we think about dividends with small caps?
Yeah, you're absolutely right. Look, we look at dividends as part of the overall capital management strategy by the board and the management team. In the small cap space, I guess most investors, we want to find the next ASX 100 company, companies that start small and over time, grows to be a much larger business, and you're getting that capital growth along the way. And when companies pay out dividends, it typically means they can't find areas where they can reinvest, the earnings that they've achieved.
Yeah.
So we don't typically look at dividends just by itself, sort of mainly in the context of the overall capital management strategy. But, I did have a look at some of the companies we hold in the fund. And, one company, it's called SG Fleet. Now, it's a sort of fleet management and novated leasing business, has a very attractive dividend yield of around 7.5% this year. And we believe they can probably grow that dividend yield to around 9% in 2026. So it's a business with good news and with a pretty large dividend yield.
Any other small caps that you just want to mention? I mean, you've given us three there, and all three, notwithstanding, you may have reduced your positions in at least one of those anyway. But anything else that you're also holding that you're pretty confident about?
Yeah, so we quite like founder-led businesses, where the founder has significant skin in the game, and he's focused on the next 3 to 5 years rather than the next 6 months. So one company in the portfolio that we have is a company that you're probably familiar with, Temple & Webster. Now, it's the leading online furniture and homeware.
Oh, Tobias.
Yes.
My partner, Jackie, she's going to love this. I reckon that we are Temple & Webster's number one customers. Well, we're not, but I tell you what, over Christmas, we bought a lot of stuff from Temple & Webster.
That's great to hear. So Temple & Webster, in our view, is a long-term idea for us. We've been there for quite a while. They continue to take market share away from the brick and mortar businesses, but they're the leader in online, but they're at a stage where they're large enough now to reap some of the scale benefits. And the platform is very modern. They are going into artificial intelligence. They're spending money on TV advertisements, and they're really trying to create, I guess, the JB Hi-Fi equivalent in the homeware and in the furniture space. So we believe that Australia is about 5 years behind the US. But there's a company in the US called Wayfair that experienced extraordinary amount of growth, given the online penetration rate kept going up. And so we believe Temple & Webster could follow a very similar path over the next 5 years.
Well, I mean, I'll remind listeners that you should always get professional advice to suit your circumstances when investing. But I'm now going to give another shout out to Temple & Webster, because I reckon their delivery is really, really good. Comes when it says it does. It is what it is. Well packed. Anyway, I digress. Before we finish, maybe you can just remind us, if I'm a mum and dad investor, I'm a bit different to you, Tobias, because Wilson Asset Management obviously has a lot more money and invests in, kind of a broader spectrum. But there'd be rules that you follow that a mum and dad investor might be able to follow too. You sort of alluded to some of them already about, longer term investing and stuff like that. But what are the 2 or 3 things that maybe retail investors can take from this podcast about how to invest?
Yeah, I guess for long-term, stock ideas, the ideal stock typically ticks 3 boxes. Firstly, I think I've touched it on earlier, it needs to be a founder-led business, or where the management team has significant skin in the game.
Mm-hmm.
So, in the case of Tuas Limited, the founder owns 35% of the company, or 37% of the company, I think. So that's a huge chunk of the business. In the case of Temple & Webster, the founder, who's the CEO, also owns quite a large part of the business as well. And so their focus is on the next 3 to 5 years, and they have a very strong alignment of interest with minority shareholders like us. The second box you need to tick is the business needs to be able to grow organically, and in particular, growing volume or the number of new customers instead of just putting up prices. So we spend a lot of time trying to understand and verifying why certain companies are winning and how sustainable is that winning advantage. And the final box is that it needs to have a very healthy balance sheet. So ideally with cash on the balance sheet and no debt. This is both downside protection during periods of volatile economic environment, but also provides management the flexibility to acquire strategically important assets or grow in adjacent areas.
Fantastic. Tobias, thank you very much for talking to Fear and Greed.
Thank you very much for having me.
That was Tobias Yao, Portfolio Manager at Wilson Asset Management. This is the Fear and Greed business interview. Remember, this is general information only and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.